Hello, I'm Justin, and today I'll be presenting regarding Signature Bank. For our tables of contents, I'll be presenting the key information as presented here. So, for the introduction, Signature Bank was actually founded in 2001 and has 37 private offices across various key states. The bank was actually mainly catered to high net worth individuals, aiming to provide personalized financial services. Signature Bank was the first FDIC-insured bank to launch blockchain-based digital platforms for its clients, representing its early innovative efforts. For its culture, Signature Bank operates in a flat organizational structure to boost banking teams to operate directly due to their absence of layers between employees. They also emphasize on providing top-notch service towards their consumers through their client-focused relationship model. One can about their one call about their flat structure could be due to the over-reliance on managers to ensure that employees are aligned. Signature Bank actually had various core operations, emphasizing on commercial real estate and private banking. It is established as the full-service commercial bank, providing services as represented. Its subsidiary Signature Securities is a licensed broker-dealer, investment advisor, offering services like investment, brokerage, and more. Lastly, Signature Financial LLC focuses on equipment financing and leasing. Now, we will be moving on to the macroeconomic environment. So, for the first slide, I'm covering these two changes. So, these environments actually all led to Signature Bank's collapse in their different ways. For inflation and growth, decrease in rates indicated slower growth signals. Since Signature's core customers are crypto firms and privately owned businesses, they are more sensitive to these economic cycles. This actually increases the uncertainty in the market, and investors will most likely refrain from making risky moves. Signature is also operating in a volatile crypto market, and meaning that the collapse of crypto firms could easily affect their investor confidence and cause liquidity risks. Additionally, following the collapse of banks like SVB and Silvergate, investor confidence dropped naturally, leading to rapid withdrawals and liquidity stress for Signature. With interest rates also rising by 4.5 points due to inflation, long-term securities lost value, increasing the risk that Signature will need to sell them at a loss to meet withdrawals. Now, I'll be moving on to the risk drivers I've identified. Firstly, the concentrated crypto base that Signature is actually operating in. Its deposits actually grew by 67% in 2021 due to the crypto deposits summing to a total of $10 billion worth. Although this was around 10% of the total deposit sum, the nature of these deposits are usually more volatile, and this can be seen through its deposits declining by 7% right after the crypto exchange FTX collapsed. Therefore, having a higher percentage in crypto deposits will actually increase the percentage of liquidity crunch appearing. Signature Bank is also regarded closely towards the crypto industry due to its core operations. Hence, when investors start hearing that prominent firms like Silicon Valley Bank, FTX crypto exchange collapsing, they will naturally start thinking that Signature might be next in line, no matter its strong financials. Investors will naturally refrain from depositing during this period, and some might opt to shift their investments away. This is evident from the reduction in Signature's deposits right after the FTX collapse. As well as rising interest rates since the March 2022, this led to actual falling bond values, impacting banks like SVB that held large amounts of fixed income securities. Similarly, Signature faced risk from unrealized loss that could become real if forced to sell during rapid withdrawals, weakening their financial stability. A heavy reliance on uninsured deposits is also a significant risk driver because it makes banks vulnerable to rapid withdrawals, particularly in the times of financial instability. Uninsured deposits are more sensitive to market rumors and news, which can quickly spread through social media. Approximately 90% of Signature's deposits are uninsured, meaning that more investors will want to pull their funds out. Besides this, Signature Bank also held low cash at 5% of its total assets, as compared to SVB of 7% and industrial average of 13%. This puts them at a risk of liquidity crunch, as when unexpected news causes rapid withdrawals, the bank will not be able to meet the rapid outflow of funds due to this low percentage. Signature Bank also operates in a volatile, lightly regulated sector, so making it vulnerable to market shifts, as increased regulatory scrutiny followed the collapse of banks and crypto exchanges, especially after reports of Signature allegedly facilitating the FTX fraud by commingling customer funds. Now, we will be zooming in on three particular timelines due for the responses of the bank management. First will be before the collapse, next will be leading up to collapse, and last will be after the collapse. In 6th of December 2022, Signature actually planned to reduce its crypto deposits amidst the crypto events to reassure its investors that there will be no instance of insolvency and instability issues. They plan to ultimately reduce from 23.5% of total deposits to about 15% to reduce exposure from volatility in crypto. Moving on, in January 2023, Signature actually reported stable growth and healthy financial and capital levels despite the crypto sector challenges. Credit ratings were actually also reaffirmed by CRAs, easing investor concerns. The bank also set a $100,000 minimum transaction to reduce exposure to digital assets. On the 8th of March, Silvergate actually announced its operational wind-down. And inside of this, Signature Bank took proactive steps to reassure the stakeholders due to fears of financial contagion. After the collapse of SBB on 10th of March, panic around the market was spread. Investors feared that market contagion and that Signature would be next in line. On this day, Signature stock price tumbles with clients beginning to withdraw their deposits. However, Signature Bank did not release any statements to ease fear and no capital raising plans at all were made, unlike SBB. Soon enough, Signature faced a liquidity crunch and they had to pledge collateral to obtain required funding to help address negative outflows. Right after the seizure of Signature Bank, board member Barney Frank released a statement mentioning the solvency of the bank was not an issue, but due to the crypto sentiment of the bank. Now, let's move on to our final segment, interesting facts about Signature Bank. For the first one, Signature Bank actually collapsed while it was still solvent, meaning that by the book, it should still be operating. It still had around 4.27 million to cover withdrawals on Monday that day. However, the FDIC took over due to various key factors like liquidity crisis and contagion fears. Last but not least, despite the magnitude of the Signature Bank collapse incident, it ranked 4th among US bank failures. The biggest one is actually the Washington Mutual Bank on 25th of September 2008. Second is First Republic Bank on May 1st, 2023. And third is Silicon Valley Bank on March 10, 2023.